Good evening. Welcome to Global Jitters. Is this the end of the free or cheap money? That's the question we're asking in this edition of our update on markets. I'm Lata Venkatesh, with me Rima Tendulkar.
Hi Lata, a deep global sell-off seen in the markets worldwide. We'll discuss that in greater detail. A quick run through of the top headlines. Panic selling grips the Wall Street. Global jitters shave off more than 400 points in the Sensex. This is the biggest fall that we've seen in the last 3 months. 3 lakh crore rupees in market capitalization wiped out in just the last 2 sessions.
Mid-caps crack over 3%, the worst fall in 6 months. Volatility index surges 15% to hit highest level in 1 month.
European markets crack as the Fed rate hike spooks investors. Wall Street futures point to a weak open. There is no place to hide. Crude and gold prices also slide. All right, overall, Monday blues have hit the Wall Street. In fact, we had a gap down opening and thereafter markets traded in a very narrow band. And at no point of time, Lata, did we attempt a bit of a recovery. And now it's a 250-point correction from the top that we saw last week. What did you make of this mayhem that we saw?
Well, we ought not have been surprised. After all, the Wall Street indices closed on Friday with over 2% cuts, no matter which index you picked. Asia today had some brutal falls with the Hang Seng index falling well over 3%. Compared to Asia, we may look actually like relative outperformers, but that's because we did part of the fall on Friday itself. And we already were looking at Europe, which today has not fallen as ferociously as the Dow had fallen. It's fallen between 1.5% and 1.6%. The manner in which Europe is panning out, and let's pull up the Dow Jones futures as well to give an indication of how things might pan out. It's a fall, but it's a cut which looks far less brutal than the one we saw on Friday. So chances are that this is a correction and not a trend reversal. The market's waiting and watching, and hence the sell-off, I would argue, is not as brutal as it could have been.
Okay, let's pose the same question to Anuj Singhal. He's also standing by to analyze the markets further for us. Anuj, clearly it's the Fed rate hike which is to blame for the Wall Street. What did you make of today's market action?
Okay, bad day for the market, but clearly not disastrous. It could have been a lot worse. The market opened gap down and actually closed at that point, pretty much flat through the day after that. So there was no incremental weakness. Yes, the market did not recover much, but look, we're talking in a market in which global markets were sliding. Hang Seng, for example, was down almost 700 points, almost 3% fall in big developed markets. A lot of markets cracking below 50-day moving average. In that context, you'll have to say that we were actually a bit of an outperformer in today's market. The big call, of course, is global in this market. The Fed rate hike is looming. Now, will the Fed call markets bluff and still go ahead with the rate hike, or will Fed develop cold feet because of what the markets are doing? That's a $1 million question, or maybe a $500 million question. But just to reiterate my point, the Nifty is still about 100 points away from 50-day moving average, while most other markets have done that. And the Bank Nifty is far away from the 50-day moving average. That actually leaves the Bank Nifty a bit vulnerable to further correction. Just let me talk about some stocks. Everything was down today. Commodities like Hindalco, Tata Steel, all the cement stocks, all the banking stocks led by ICICI, Axis, Yes Bank, other heavyweights like Larsen, Tata Motors, ITC, they were all down. The only saving grace today was that IT was outperforming. So Infosys, Techem, and HCL Tech ended in the green. And outside the index, there were a lot of non-index losers, like all the real estate stocks led by HDIL, Reliance Infra, and of course, Kane and Vedanta. So all in all, a bad day, but the bulls may want to believe that as of now, they are still in this market.
Okay, thanks a lot for that, Anuj. Well, let's get to the global cues. As Anuj said, today it's all about global cues that pulled Indian markets down and, in fact, pulled every market down. So to discuss how things might pan out in terms of global flows, Robert Parker of Credit Suisse joins us. Mr. Parker, good evening to you, and thank you very much indeed for joining us. What does this look like? Just a correction after practically 9 weeks of steady upward climb, or is this more serious?
I think what's changed over the last couple of weeks, and of course one has to focus on 2 background points, which is number one, that the VIX and other volatility indicators were very low during August and early September. So that was giving us a warning signal in terms of the outlook for potential volatility in the market. I think the other factor that's changed in the last few days is that investors are not focusing on whether the Fed raises rates in September or December. I think there's a very clear consensus that they will actually raise rates in December, and that's been my view for some time. But I think what has changed is investors are now looking increasingly to what the Fed will do in 2017. And I would come back to a statement that Janet Yellen made a couple of months ago, which is that she said the Fed target is to have a zero real Fed funds rate. So if you believe, as I do, that next year we'll see core and headline inflation in the United States averaging 2%, that obviously takes us to a position whereby towards the end of next year or early 2018, we could be looking at a Fed funds rate of 2% as in contrast to the 50 basis points now. So I don't think investors are that worried about what happens this month or next month, but I think they're increasingly looking to a sustained period of the Fed normalizing interest rates, and that obviously means higher U.S. Treasury yields, and that in turn has a longer-term negative, is a longer-term negative factor for global equity markets.
Good evening, Mr. Parker, and thanks so much for joining in. So the next Fed rate hike could be in December, but the street is worried that in 2017, we will see more Fed rate hikes than what was earlier priced in. Does that mean the sell-off or correction that we are seeing in the global markets will persist? How deep could it be, and what would be the time correction that you would give?
Well, I'm going to give you a very unsatisfactory answer, which is that my view is that the global equity market rally, which started in March 2009, and if one looks at developed markets as opposed to emerging markets, but I think developed markets peaked in May and June 2015. And I think for the reason why my answer is very unsatisfactory is because I think for the next 2 to 3 years, we could be in for a sideways moving market. And yes, there are a lot of factors which are supporting markets, but likewise, I think whether it's the Fed raising rates, whether it's some markets with very high valuations like America, like whether it's the poor growth outlook, I think one can list a raft of factors which put a ceiling on the global equity market outlook. So I don't think we're going back into a major bear market as we saw in 2007 or like we saw in 2001, but I do think that the scope for an extended rally from these levels is very limited. And I think we have to focus, at least in the short term, on downside risks. And to quantify that, if you look at Euro stocks, currently just close to 3,000, I think that could easily go down to 2,900. And likewise, the S&P, I think there's downside over the balance of this year down to around 1,900. So I'm afraid that we're probably going to have a bias to the downside over the next couple of months at least. And longer term, I think a sideways moving market.
Okay. Do you think the January lows or early February lows are very much possible? Or is that even your base case in 2016?
The January lows are slightly lower than where we are today and slightly lower than where I expect that we will go. Okay. So, if to quantify it, is the S&P going back to 1,800 compared with 2,100 now? I think the answer to that is very low, but I wouldn't be at all surprised if we settle down between 1,900 and, let's say, 1,950 on the S&P, and so likewise 2,900 on the Euro stocks. Now, one factor which obviously one has to consider is that QE will continue in Europe and in Japan. And that, of course, that 80 billion a month in Europe for quantitative easing is market supportive. So, as I say, I don't think we're going into a trend bear market, but it's going to be this rather unsatisfactory sideways moving market, but in the short term with a downside bias.
So global market sideways for the next 3 to 4 years. Does India outperform in this period?
India is going to be probably the fastest growing economy in the world. And just to sort of quantify that, in 2018, a reasonable forecast for Chinese growth would be sub 6%, perhaps between 5.5% and 6%. Russia and Brazil are coming out of recession, but, their growth numbers are going to be mediocre, where, Indian growth, I think, on trend, can hold above 7%. That, as a growth hub and a growth leader, will attract foreign capital and will mobilize domestic capital into real assets in India. So, yes, your market's expensive, but frankly, I think it's going to stay expensive. So I think generally emerging markets will outperform developed markets over the next 2 to 3 years, as they have done already this year. I think India will stay an expensive market and will probably be one of the outperformers. And, one just has to, for foreign investors, they are very impressed with the outlook for Indian growth.
Yes, the numbers, the delta definitely looks positive, but of course it's a low base. But Mr. Parker, finally, what's the near-term outlook? I mean, we have one of the Fed dovish governors speaking later today, that is Brainard. As well, there is a feeling that even Draghi wasn't as giving as he was expected to be. Is there a feeling that central bankers generally, and Kuroda could do the same on September 21st, are generally being less dovish because all that QE is not working? And in the near term, what are you expecting Brainard to do to the markets?
Well, I think the first point to make is that QE has worked in that it has prevented the global economy going back into recession. But having said that, an interesting question which central bankers are reviewing at the moment is QE and easy monetary policy starting, particularly in Europe and Japan, are the monetary tools starting to look rather tired and exhausted? And I think we all agree that there is a lot of evidence that that is the case. Consequently, there is increased pressure on fiscal policy. And, whoever is American president in 2017, I think we're going to see an easing in fiscal policy there. In Japan, I think fiscal policy will be eased. It's Europe that we've got a problem because we have a raft of geopolitical issues in Europe with elections coming up in a number of key countries like Germany. So the scope for fiscal easing in Europe, I think, is much more limited. Now, coming back to your question of short term, obviously, after the big move on Friday and today, at least in Europe, and I think it'll be extended into the States, short term, the markets are looking a little bit oversold. So, I would be surprised if for the rest of this week that the sort of selling pressure of sort of 2% a day is going to be extended throughout the rest of this week. But having said that, I think the scope for a major bounce is very limited indeed.
All right, we'll leave it at that. Robert Parker, thank you very much for joining us. So scope for bounce is limited, but not expecting such a huge sell-off. That's at least some positive. What does that mean for Indian markets, and where do you take shelter? Where do you sell off? All those questions to our expert Jyotivardhan Jaipuria, who will be joining us in a minute after this break. But before that, let's leave you with a couple of more opinion that we got through the day. Here's what people like Nilesh Shah have made of the markets.
I think September is definitely a live possibility. I think that's what these comments are kind of hinting at. But the market's not quite there yet. The market is thinking more like December. If the Fed keeps to this process and doesn't keep interest rates artificially low.
As we see a different scenario of slightly rising yield and probably central banks around the world talking about raising interest rates, that's going to put some amount of consolidation phase in our market. And we do expect some amount of correction to continue, but it's a correction in a consolidation form. Our markets have run up since February 2016. So it's important for them to take a pause, correct little bit so that they can jump later on.